October 1907 was supposed to be just another month in America's Gilded Age, a time of unprecedented wealth, industrial expansion, and financial speculation that made fortunes overnight and destroyed them just as fast. But within 3 weeks, the entire American financial system would be hours from total collapse, bank runs would spread across the country, and the stock market would crash so severely that the New York Stock Exchange nearly closed permanently. The Panic of 1907 was the first worldwide financial crisis of the 20th century, and it transformed a recession into a contraction surpassed in severity only by the Great Depression. But this crisis was different from the dozens of banking panics that had plagued America throughout the 19th century. This time, the panic was so severe, the consequences so catastrophic, and the rescue so dramatic that it changed how the entire world thought about banking, money, and financial stability. Within 6 years, the Panic of 1907 would lead directly to the creation of the Federal Reserve System, fundamentally rewiring not just American finance, but establishing a template for central banking that would be copied globally. Understanding this panic means understanding how 1 month of financial chaos created the architecture of modern money, how private bankers who saved the system then designed its replacement to ensure they'd never have to risk their own fortunes again, and how a crisis supposedly solved by heroic intervention actually revealed the fundamental fragility of a financial system built on confidence, leverage, and the assumption that someone would always be there to bail it out. The stage was set years before the panic struck. America, in the early 1900s, operated without a central bank, a deliberate choice rooted in deep distrust of concentrated financial power that dated back to Andrew Jackson's destruction of the Second Bank of the United States in the 1830s. For 70 years, America's banking system had been decentralized, with thousands of state-chartered and nationally chartered banks operating under different rules with different reserve requirements and different levels of oversight. The system was inherently unstable. Banks held reserves far below their deposit liabilities, trusting that not everyone would demand their money simultaneously. And there was no lender of last resort, no institution that could provide emergency liquidity when panic struck and depositors rushed to withdraw their funds. Making the system even more fragile were trust companies, financial institutions that performed many bank-like functions but operated with less regulation and lower reserve requirements than traditional banks. Trust companies attracted deposits by offering higher interest rates than banks could, made risky investments in loans that banks couldn't, and grew explosively in the early 1900s as wealth accumulated during the industrial boom sought higher returns. By 1907 New York, trust companies held deposits equal to roughly half of the city's national banks, but maintained reserve ratios far lower, sometimes as low as 5% compared to the 25% that national banks were required to hold. The man who would unwittingly trigger the panic was Augustus Heinze, a Montana copper magnate who'd made a fortune through aggressive mining claims and dubious financial practices. Heinze came to New York in 1906 with his brothers and established control over several banks and a brokerage firm, using these institutions to finance increasingly speculative ventures. Heinze's partner in these schemes was Charles Morse, another financier who'd built an empire through consolidating ice companies, steamship lines, and banks, earning the nickname Ice King of New York. Both men exemplified the era's financial recklessness, using deposits from banks they controlled to speculate on stocks, particularly in copper mining companies. The specific trigger came in October 1907 when Heinze's brother Otto, working with a speculator named Charles Barney, attempted to corner the market on United Copper Company stock. A corner means buying up enough shares that you control the supply, then forcing short sellers who need to buy shares to cover their positions to purchase from you at inflated prices. It's market manipulation, but in 1907 it was legal and common. The Heinze Group believed that short sellers had overextended themselves on United Copper stock and that a corner would generate massive profits as those short sellers were forced to buy at any price to close their positions. The scheme failed catastrophically. When the corner was attempted on Monday, October 14th, it turned out there were far more United Copper shares available than the Heinzes had calculated. Instead of being forced to buy from the corner at high prices, short sellers easily found shares elsewhere and covered their positions. United Copper stock, which the Heinzes had driven up expecting to sell at even higher prices, collapsed from $60 to $10 in a single day. Otto Heinze was ruined instantly. His brokerage firm failed, and the banks associated with the Heinze brothers, where they'd borrowed money to finance the corner, faced massive losses. Within days, depositors began withdrawing money from banks connected to Heinze and Morse, fearing that the failed speculation had made those institutions insolvent. The State Savings Bank of Butte, controlled by Heinze, faced runs and closed. The Mercantile National Bank in New York, where Augustus Heinze was president, came under siege from depositors demanding their money. The New York Clearing House, an association of the city's major banks that facilitated check clearing and occasionally acted collectively during crises, intervened. They provided emergency loans to Mercantile National, but only on the condition that both Heinze and Morse resign from all banking positions immediately. The message was clear: the established banking community would support institutions but not the reckless speculators who'd endangered them. But the panic didn't stop with Heinze and Morse's banks. It spread to trust companies, particularly the Knickerbocker Trust Company, one of New York's largest with over $60 million in deposits. Knickerbocker's president, Charles Barney, had been involved in the United Copper speculation with Otto Heinze. When this connection became known, depositors panicked. On Tuesday, October 22nd, a run began on Knickerbocker Trust. Lines formed outside the bank's doors as thousands attempted to withdraw their deposits. The trust company paid out $8 million in 2 hours before its reserves were exhausted and it suspended operations, closing its doors with depositors still in line. The closure of Knickerbocker Trust, a respected institution that hadn't been obviously connected to the failed corner until Barney's involvement was revealed, transformed a limited crisis into a full-blown panic. If Knickerbocker could fail, no trust company was safe. Runs began on other trust companies across New York. The Trust Company of America, the Lincoln Trust Company, and others faced withdrawals they couldn't meet. Stock prices on the New York Stock Exchange plummeted as investors sold anything they could to raise cash. And critically, the banks that normally provided short-term loans to stockbrokers to facilitate trading withdrew that credit, fearing they wouldn't be repaid. Without credit to finance stock purchases, the market entered freefall. By Thursday, October 24th, the situation was desperate. At 1:30 p.m., Ransom Thomas, president of the New York Stock Exchange, rushed to the offices of J.P. Morgan to inform him that the exchange would have to close early because there was no money to finance trades. Morgan understood that closing the exchange during a panic would be catastrophic, signaling that the entire financial system had failed. He gathered New York's bank presidents at his office and informed them they needed to provide $25 million immediately to keep the exchange open. Within minutes, the banks pledged the funds, and messengers rushed to the exchange floor at 2:16 p.m. to announce that money was available to lend at high but not impossible rates. The market stabilized temporarily, but the crisis was far from over. That night and into the next morning, Morgan orchestrated a more comprehensive rescue. He brought together the presidents of New York's trust companies and informed them bluntly that they had to provide a $25 million loan pool to support the weaker trust companies or face complete collapse of the entire trust system. The trust presidents were reluctant, understandably unwilling to risk their own institution's capital to save competitors. But Morgan was insistent, and his reputation and position gave him authority that no government official could match at that time. Through sheer force of personality and veiled threats about what would happen if they didn't cooperate, Morgan kept the trust presidents locked in his library negotiating through the night. At approximately 4:45 a.m., he persuaded the unofficial leader of the trust companies to sign the agreement, and the other bankers followed. The immediate crisis was contained, but barely. Yet another crisis emerged before the week ended. A major brokerage firm, Moore & Schley, faced bankruptcy because it had borrowed extensively using shares of Tennessee Coal, Iron and Railroad Company, TC&I, as collateral. If Moore & Schley failed, it would have to dump TC&I shares on the market, crashing the stock price and potentially triggering failures of other firms that held TC&I shares or had lent against them. Morgan engineered a solution that was brilliant, profitable, and possibly illegal. He arranged for U.S. Steel, the massive corporation he'd helped create in 1901, to purchase TC&I at a fire sale price. This would save Moore & Schley by giving TC&I shares value. But U.S. Steel was already the dominant steel producer, and acquiring a major competitor would normally violate antitrust laws. Morgan sent emissaries to Washington to meet with President Theodore Roosevelt, explaining that the purchase was necessary to prevent financial collapse. Roosevelt, who'd built his reputation as a trust buster fighting corporate monopolies, reluctantly approved the deal, giving Morgan what he wanted. By November, the acute phase of the panic had ended. But the damage was severe. Dozens of banks and trust companies had failed, the stock market had fallen nearly 50% from its peak. Credit had dried up, causing businesses to cut production and lay off workers. The economy entered a recession that would last into mid-1908. And public attention turned to the uncomfortable question, how had the financial system come so close to total collapse, and what could be done to prevent it from happening again? The answers to those questions would reshape American and ultimately global finance. The immediate response was the Aldrich-Vreeland Act, passed in 1908, which created emergency currency provisions and, more importantly, established the National Monetary Commission to study banking systems in the United States and Europe and recommend reforms. The commission was chaired by Senator Nelson Aldrich, a powerful Republican from Rhode Island with close ties to banking interests and family connections to the Rockefellers through his daughter's marriage to John D. Rockefeller, Jr. What happened next has become one of the most famous episodes in American financial history, part fact and part legend, but revealing regardless of how much was planned versus how much developed organically. In November 1910, Senator Aldrich organized a secret meeting at the Jekyll Island Club, an exclusive resort off the coast of Georgia. The attendees included Aldrich himself, his personal secretary, and representatives of the nation's most powerful financial institutions. Henry Davison of J.P. Morgan & Company, Frank Vanderlip of National City Bank, now Citibank, Paul Warburg of Kuhn, Loeb & Company, Charles Norton of First National Bank, and Benjamin Strong of Bankers Trust. They traveled to Jekyll Island in secret, using only first names to avoid recognition, and spent a week drafting what would become the blueprint for the Federal Reserve System. The secrecy was deliberate. Banking reform was politically toxic. Populist movements, particularly in the South and West, were deeply suspicious of Eastern banking interests and opposed to anything that looked like a central bank controlled by Wall Street. At the same time, many bankers, particularly smaller regional banks, feared that a central bank would be controlled by government and used for political purposes rather than sound financial management. The Jekyll Island Group needed to design a system that could attract support from these divergent interests while actually serving the goals of the financial elite who were designing it. The solution they crafted was ingenious in its deception. Instead of a single central bank, which would have been politically impossible given American history and Andrew Jackson's legacy, they proposed a regional system of Federal Reserve banks. This gave the appearance of decentralization, suggesting that no single institution would dominate. But operational control would be centralized in the Federal Reserve Board and particularly in the New York Federal Reserve Bank, which would be closest to Wall Street and would naturally dominate policy given its position in the nation's financial center. Member banks would be required to purchase stock in their regional Federal Reserve banks, making the system appear privately owned and operated. But the Federal Reserve would be granted government powers, including the authority to issue currency, set reserve requirements, and act as fiscal agent for the U.S. Treasury. The structure blurred the line between private and public, creating an institution that could claim independence from both democratic accountability and pure profit motive depending on which was more convenient at any given moment. The National Monetary Commission issued its final report on January 11, 1911, incorporating the Jekyll Island Plan with modifications. For nearly 2 years, Congress debated the proposal amid fierce opposition from populists who saw it as a Wall Street takeover and from conservative bankers who feared government control. The breakthrough came when Democrats won the presidency and Congress in 1912, bringing Woodrow Wilson to power. Wilson had initially opposed the plan but was convinced by advisors, particularly Colonel Edward House, that banking reform was necessary and that the Federal Reserve structure provided sufficient government oversight to prevent the abuses of pure private control. The Federal Reserve Act passed on December 23, 1913, just before Christmas recess, when many congressmen had already left Washington, and Wilson signed it the same day. The legislation creating the Federal Reserve System was now law. Charles Hamlin became the Fed's first chairman, and Benjamin Strong, one of the Jekyll Island conspirators and a key lieutenant of J.P. Morgan, became president of the Federal Reserve Bank of New York, the most powerful position in the entire system. The men who had nearly let the financial system collapse in 1907, who had been saved by J.P. Morgan's intervention using his personal wealth and influence, now controlled an institution that could create money, provide unlimited liquidity, and bail out banks without risking any private fortune. The Federal Reserve was officially established with 3 main purposes: to serve as a lender of last resort providing emergency liquidity during financial panics, to serve as fiscal agent for the U.S. government managing Treasury accounts and facilitating government borrowing, and to act as a clearinghouse for checks and other banking transactions. These were worthy goals, and in theory, the Fed could help stabilize the financial system and prevent future panics. But understanding how the Fed actually operates versus its stated purposes requires looking at who benefited from its creation and how it has functioned over the following century. The primary beneficiaries were the large banks and financial institutions that had designed the system. Before the Fed, banks faced the risk that panics could destroy even sound institutions if depositors lost confidence. The only defense was maintaining high reserves, which limited profitability, or relying on wealthy financiers like Morgan to organize rescues, which was uncertain and politically dangerous. The Fed solved this problem by providing a permanent backstop. Banks could now operate with lower reserves knowing that the Fed would provide emergency loans if needed. This allowed higher leverage and greater profits while socializing the risk of failure. The public was told that the Fed would prevent panics like 1907 from ever happening again. This was at best half true. The Fed would indeed provide liquidity during panics, but that liquidity was designed primarily to protect banks and the financial system, not depositors or the broader economy. And the Fed's existence created moral hazard, the economic principle that insurance against risk encourages riskier behavior. Banks that knew they could borrow from the Fed during crises had less incentive to maintain prudent reserves or conservative lending practices. The Fed didn't eliminate the causes of financial instability, it just changed who bore the costs when instability erupted. The Fed's first major test came with World War I, which began in Europe in 1914, just months after the Fed opened for business. The Fed facilitated massive government borrowing to finance American participation in the war after 1917, creating money to purchase treasury bonds and providing preferential loans to banks that bought government securities. This was exactly what the Jekyll Island group had designed it to do, enable government spending on a scale that would have been impossible through direct taxation while ensuring that banks profited from financing that spending. The precedent was established. The Fed existed not primarily to prevent panics, but to facilitate government borrowing and protect bank profitability. Throughout the 1920s, the Fed pursued expansionary policies that fueled credit bubbles in stocks and real estate. Policies that New York Fed President Benjamin Strong dominated despite supposed oversight from the Federal Reserve Board in Washington. When those bubbles burst in 1929, triggering the Great Depression, the Fed failed catastrophically, allowing the money supply to contract by 1/3 and doing nothing as thousands of banks failed. The institution created to prevent panics presided over the worst financial collapse in American history. Yet rather than being abolished for incompetence, the Fed emerged from the Depression with expanded powers, authority to regulate banks more closely, and even greater control over monetary policy. This pattern has repeated throughout the Fed's existence. Crisis emerges, often facilitated by Fed policy or regulatory failures. The Fed responds with emergency measures that protect banks and financial institutions. And the crisis becomes justification for giving the Fed more power, more tools, and more authority. The 2008 financial crisis, strikingly similar to 1907 in many ways, followed this script perfectly. The Fed had failed to regulate the mortgage lending and securitization that caused the crisis. When panic struck, the Fed provided trillions in emergency loans to banks and shadow banks. And afterward, the Fed received expanded regulatory authority and began purchasing assets on scales that would have been unimaginable to previous generations. The Panic of 1907 rewired the world financial system by establishing the template for modern central banking, an institution that claims to serve the public interest but is designed by and primarily serves financial elites, that operates with minimal democratic accountability while wielding enormous power over the economy, and that uses crisis as justification for expanding its own authority. The structure created at Jekyll Island has been copied globally. Nearly every country now has a central bank modeled more or less on the Federal Reserve System. These institutions claim independence from political interference while making decisions that profoundly affect politics and society. They claim to pursue public goals like price stability and full employment while primarily focusing on financial system stability, which in practice means protecting banks. The conventional narrative of 1907 is heroic. J.P. Morgan saved the financial system through his wisdom, courage, and willingness to risk his own fortune, and the crisis taught America that it needed a central bank to prevent future panics. There's truth in this narrative. Morgan did organize the rescue, and it did work. But the deeper truth is less comfortable. Morgan and other financiers saved the system not primarily from altruism, but because its collapse would have destroyed their own fortunes. The rescue required risking their wealth, which they understandably found unacceptable as a permanent arrangement. The solution was to create an institution, the Federal Reserve, that could provide the same rescue function using public money and money created from nothing rather than private fortunes. The Jekyll Island meeting wasn't a conspiracy in the sense of evil men plotting in secret to harm the public. It was a conspiracy in the literal sense. Wealthy, powerful men meeting secretly to design a system that would serve their interests while claiming to serve the public. They succeeded brilliantly. The Federal Reserve System has operated for over a century, surviving multiple crises, expanding its powers repeatedly and becoming so embedded in the financial architecture that its existence is rarely questioned. Most people have no idea that the Fed is not a government agency, but a hybrid public-private institution where regional Federal Reserve banks are owned by member banks, or that the New York Fed has always been dominated by Wall Street interests, or that the Fed's track record of preventing crises is actually quite poor despite its mandate. Understanding how the panic of 1907 rewired the world financial system means understanding that financial architecture isn't neutral. It's designed by those with power to serve their interests. The panic itself was caused by reckless speculation enabled by inadequate regulation and a fragile banking system that operated on confidence and leverage. The rescue was organized by the very financial elites whose system had failed, and the institutional response, the Federal Reserve System, was designed in secret by representatives of the largest banks to ensure they would never again have to risk their own wealth to save the system. This isn't ancient history. The mechanisms established in 1907 to 1913 are still operating today. When crisis strikes, the Federal Reserve provides emergency liquidity to protect the financial system. Large banks and institutions know they will be bailed out because their failure would threaten systemic stability. Moral hazard encourages risk-taking that generates private profits during good times and socialized losses during crises. And the Fed operates with minimal oversight, making decisions affecting hundreds of millions of people while answering to no one except in the loosest sense to Congress and the President who appoint board members. The world financial system was rewired by a banking panic not through careful democratic deliberation about what kind of financial architecture would best serve society, but through secret meetings of financial elites designing a system to serve themselves. That this system has survived, expanded, and been copied globally speaks to its effectiveness at serving its actual purpose, protecting financial institutions and enabling government spending while concentrating power in unaccountable institutions. Whether it serves broader public interest is at best uncertain and at worst clearly negative given the repeated crises, bailouts, and inequality that have characterized the Fed's century of operation. The Panic of 1907 teaches that crisis is opportunity for those positioned to exploit it. J.P. Morgan's intervention made him more powerful, more celebrated, and more able to shape the system's redesign. The Jekyll Island conspirators turned their embarrassing need for a rescue into control over the institution that would provide future rescues. And the Federal Reserve, born from panic, has used every subsequent crisis to expand its power and authority, always claiming that more power is necessary to prevent the next crisis, while rarely acknowledging its role in creating the last one. If this gave you a new perspective, hit subscribe. History doesn't repeat, but banking panics always do. And the institution created to prevent them profits from every crisis, expanding its power while ensuring that the next panic will require even more intervention, more bailouts, more control. The rewiring finished in 1913 was never meant to be permanent. It was designed to be expandable, growing with each crisis until the distinction between private banking, central banking, and government became so blurred that no one could tell where one ended and another began. That was the point all along.